It's a great honour to be here. I do represent ANZ, given they're paying for my time right now, but speaking to an audience under a CEDA banner, I do feel obliged to give a frank and fearless view of what we see as the challenges for Australia. This morning, a lot of the focus was on domestic politics and international economics. Fascinating stuff, and of course the international economy is absolutely critical. But I want to try and focus the speech today on what's the dynamics driving the Australian economy, to give some views what I think could be a policy implication, give you guys some food for thought, especially the incoming Treasurer or the new Treasurer, and also of course try and paint a picture of where Australia could be over the next few years. I will try and stick to the economics, but economics and politics are linked and we can't avoid them. Professor Martin suggested I talk about all the things I got wrong last year. I don't have time for that. We've only got 20 minutes, so I better get on with it. All right, lots of charts to look at as usual with an economist. So this is the world economic backdrop, and I'll just touch on a couple of key points here and on a couple of the key economies. So this is economic growth in recent times, split by emerging economies and advanced economies, and as you can see, of course, the emerging economies are absolutely critical to the economic growth or wealth generation process for the world. So we in Australia are highly familiar with this, with our relationship with China and Asia more broadly, but this will continue to be a feature. We are looking for recovery. In the vein of past mistakes, we've been looking for this recovery for some years. We've been glass half full types. There are plenty of risks out there, but there are also many positive features of the world economy and fantastic opportunities for business and people more generally to advance themselves. The interesting point is that we weren't right, but we weren't wrong. The world economy for the last 3 years has stayed at the same rate of growth, which actually, as you can see from this brief history, is very unusual. Economies are often characterised by their cyclical nature. We are on a knife edge. We're on a knife edge because there's a whole range of different forces at work. Forces for change, forces that we're trying to deal with in terms of problems of the past and opportunities of the future. And that's keeping everything seemingly on an even keel, but there is also a knife edge feel to it where there are risks that could suddenly become prominent, or of course they could start to fade and the positive forces come into play. We think the world's getting better, even though China's slowing. That's necessary and will continue. An economy that big can't grow at this pace, and it will slow down every year for the foreseeable future until it's probably growing at something more like Australia's rates of growth of 2, 3, 4% within 10 years' time. The United States will be better next year and is doing very, very well, and I'll touch on that in a minute. And we've just seen, despite the challenges Japan and Europe face, significant structural challenges, their latest readings for economic growth in Q4, both released in the last week, have improved and shown growth after a couple of negative quarters or technical recession. So we can't hope for much more out of Japan or Europe than a little bit of growth and a lot of stability, if you can have a lot of stability. Because those are economies that have significant demographic challenges. That is, they have naturally slowing growth because of shrinking populations, and Europe's a little bit behind Japan on that front. So stability there and improvement elsewhere is important. Before I move on to China and America, there are risks out there which I don't want to dwell on, but we have clearly embarked on a whole era of uncharted monetary policy with this unconventional monetary policy easing, the quantitative easing, or some people will call it the printing of money. And the ECB is the last central bank to succumb to the lure of trying to effectively debase their currency, reduce their exchange rate and make their local economy more competitive versus the rest of the world. And that is the end game for QE. It's about your exchange rate. And with the Europeans about to buy more than twice the expected issuance of government bonds from all the governments of Europe in the next 12 months, I have no doubt that the euro will fall and European manufacturers and European businesses will be more competitive. The point is will we see some repercussions of this down the track? And that is a question that remains and will remain and is not clear. Printing of money is technically inflationary. The world faces the completely opposite problem of deflation. So that's a risk that sits out there. The other risk that's associated with it is there's been a surge in borrowing by corporations around the world in currencies other than their own, i.e. in US dollars, particularly in the emerging world, particularly in China. With US dollar rising, with US interest rates rising, that could bring some pressures on the corporates who have been doing this and, of course, create some financial distress. It's early days, it's getting some focus in markets and from international agencies, but that's something to watch as well. And, of course, we have some risks that sit in domestic economies. So I want to focus on the US, which for 12 months has had a strong consensus of improvement. And in my game, which is financial markets, when everyone thinks the same thing, it's usually wrong. In this case, it has been right. The US is looking very, very good. It is generating domestic jobs. Look at that unemployment rate. It's fallen incredibly. That does mask some structural unemployment, some long-term unemployment. These are challenges that the US does face, but their economy is progressing. And we think it will continue and that the Federal Reserve will have to raise interest rates, which is actually a healthy sign, and the process of normalisation will begin. But the US economy does represent a significant risk to the world, and that is this risk that we're all expecting it to deliver for the world. It is the engine of world growth. This is the old model, of course, and I think that one of the most prominent risks out there is if something happened in the US. It would really pull the rug out from expectations and potentially from global growth and have significant implications for capital flows. At this stage, there is no reason to believe that it will. It's looking fantastic. So the US is a key pillar to the world economic outlook and therefore Australia's economic outlook. And I must also note on this point that there is a significant amount of evidence that shows the non-mining economy, and we'll talk a lot about that in a minute, in Australia is highly correlated with the US economy. So if the US is doing well over the next few years, that's fantastic for businesses outside of the mining sector and the overall economy here over the next few years. China, of course, is critical. I think China is an amazing story. I think the best days for our resource sector in terms of growth and super profits and this sort of thing are all behind us. I think most of us accept that, but they remain a critical market for our resource industry. But more importantly, they will be an absolutely undeniable opportunity for all major industries and exporters in this country over the decade ahead. The problem is that they are changing and we've got to adapt and understand what those opportunities are. The FTA will help us realise that, but it is not a silver bullet. The relationships, the hard work has to be done on the ground. Governments and business working together will probably get the best outcomes. But China's economy is changing. It's slowed down. It doesn't feel like it's slowed down that much in the sense that GDP is growing at 7.4. Yes, that's the slowest rate in a whole number of years, down from 8 or 9. That's still a tremendous rate of growth. For Australia, though, it's the industries that are important to our resources side that have slowed down quite a bit. And their economy is necessarily transforming. It is moving towards that service sector, consumer-led domestic economy that will be critical for China taking the next step, higher income levels and a high level of overall economic and social development. And it's happening very quickly. China is in a hurry and their government is pushing through substantial reforms. There are risks out there, though. The problem of slower growth and structural problems, which was outlined by John Hewson this morning, I think is prominent. They have a number of structural problems related to everything from environmental issues and social and political issues to numerous economic ones. And I think a lot of those could come into play. So the government will have to get that balance of reform and growth right, and they're still talking significant rates of growth. The real problem is if they try and keep growing their economy at 7 and it's too hard, is that it could stress some of the already emerging financial imbalances, such as around their property market or their local governments. My view and the view of ANZ is that China will continue to be stable and they'll continue, as they have for a number of years, meet the challenges of this reform process without creating any financial or economic downturn or significant downturn. And the reason that is that they still retain significant control over how the financial affairs of that country runs. There's very little chance of a major systemic problem entering China. So I think for the time being we should remain optimistic on China, but of course I think it's the opportunity is what we should focus on when talking about Australia's future opportunities outside of just the resource sector. All right, now moving to Australia on that backdrop, which is a cautiously optimistic one for the world economy, noting risks still there, but progress is likely to be made. I'll just go through first the challenge for us, and that's dealing with the remnants of this amazing mining and energy boom, the massive capital expenditure that was put in place in the last decade, half decade to a decade in this country. This year it will be felt the most. This is our major project spend that we do at ANZ. We look at all the different company accounts. We try and get the best feel of all the spend that's going to occur project by project for mining, energy and infrastructure. And you'll see here that in 2015 the black line, which is the line there, the dark blue line, is our projection for what will likely occur in terms of spending. We're going to lose about 25 billion of CapEx this year that we had last year. That's a huge hole to make up for in terms of spending in this economy. Of course, the two states which will feel this the most are Queensland and Western Australia. And how do we make up for that? Well, there has been a lot of talk about governments and their infrastructure plans, and these are critical. This is, again, a very painful exercise we've done to build up all the different infrastructure projects that are sitting out there, mainly road and rail. There are some other things. There's a few things to note. The first one is that it takes a number of years for this spending to ramp up. So it's not going to replace the mining CapEx anytime soon. And the other thing to recognise is that magnitude. That is 12 billion in 2017. Go back a chart, we're talking in the tens of billions. The peak in this was 90, 100 billion. Governments, if they're going to make up for this, and I'm not saying taking the spend all the way back to 90 or 100 billion, but have a lot of extra infrastructure to do. If infrastructure is going to lead the way over the next half decade, the magnitudes of spending have to increase phenomenally. I think most people agree that that is a sensible policy assessment to think about, but there are major political and financial challenges around that. The other thing to note, and I really don't want to depress you too much because I will get onto some nicer stuff, is that all of that government infrastructure spending is factored into those numbers you see right in front of you. So whether or not the government delivers on those infrastructure plans, the overall major project spend in this country is coming off sharply still for another 3 years. So we have to grow the rest of the economy. Business as usual is what I've called it. It's what happened, prior to 2003. And for the time being, we actually have to grow the economy a little bit harder. We have to offset that downturn in mining spend by growing domestic demand. And at the moment, we are growing it. It's not very consistent across industry. It's not consistent across geography, but we're not growing it fast enough. It has to continue to build momentum. So the non-mining recovery was always going to be led by the residential property sector, dropping interest rates a few years ago, getting prices going there, which would trigger activity and trigger construction jobs in an industry that had been very, very subdued. We built up a significant underinvestment in property, and now we're getting back to business as usual and building houses again, which we didn't do at the appropriate rate while the mining boom was going on. But it's more than that. That's just the first phase. We need to broaden it beyond that. We can't just have a residential and commercial construction boom, which of course is very uneven across the country and has the potential to get us into some trouble down the track if we rely on it. We must get a broader business investment happening. And this is, I think, really critical to getting that happening is business confidence. Business confidence took a huge step up on most measures. Here's the Roy Morgan measure, the NAB measure, when the coalition government was elected federally at the end of 2013. It held in at reasonable levels, and in the last few months of last year it started to sag. Now the underlying economic data didn't look that bad. Retail sales, building approvals, things like this were all okay. It must be some other factor at work. I think a bit of political instability doesn't help. Obviously the electorate is a lot more sensitive to political issues. The Queensland election result, the big swing that we saw in the electorate here, all the ways we're seeing reactions to things like the leadership tensions, the way this morning ANZ and Roy Morgan released the latest weekly consumer sentiment. That was down, measured over the last weekend. I'm sure the problems in Canberra had something to do with it. We do not need business confidence going south. We need a building momentum. Businesses are the ones who are going to invest and create the jobs, and the confidence needs to be supported. The government sector will not. So long as the plans are for fiscal consolidation, which is important, governments must get their recurrent budgets in order. They can't continue, as we know, to run recurrent deficits. It's unsustainable that we will get us into a dark path. That doesn't mean governments shouldn't be spending. They can spend on infrastructure till the cows come home, and the financial system will provide the funding for that. I'm sure the rating agencies won't get upset with that. But in terms of recurrent budgets, they must address some of the issues that have emerged in the post-mining boom world. And that means in doing that, they're not contributing to the economy the way they used to. Public sector in Australia, federal and state, is about 25% of the overall economy. Therefore, in the history, it's contributed about a quarter of economic growth. With fiscal consolidation, it's contributing a lot less. And I'd imagine, unless something radically changes in Canberra, that is going to continue. So we need the private sector, we need the business sector to lead the way. The consumer is not going to lead the way, as it did in the late 90s after the Asia crisis. We're not re-leveraging the Australian consumer, racking up household debts and mortgages and so forth, but the consumer has to be in the game. The consumer has to be confident and spending, because businesses will not invest if there's no market, if there's no demand there. And the thing about the Australian consumer right now is it's very lacklustre. Both the Roy Morgan ANZ measure and the Melbourne Institute Westpac measure are both right together, just under long-term average levels, which isn't bad, it isn't good, it's not great. Given the fall in petrol prices, given the good summer we've had, it's been pretty sunny in most of Australia, you'd think it would be a little bit higher, but no, they're quite lacklustre. And this is the really interesting feature of it. In the questions that the Roy Morgan survey puts out that relate to current conditions, consumers are okay. We've got a job, house prices are going up, interest rates are low, my financial situation is pretty good. Anything about the future, consumers are worried about. So this is going to be another key policy issue. The Reserve Bank's talked about it. It's very difficult, these sorts of psychological elements to the economy. They're more important than ever, but how do we support consumer confidence? Why is there this huge divergence? And there's no doubt that a highly levered consumer, where there's a lot of consumer debt, which isn't in and of itself a problem, but consumers are very sensitive to economic news and obviously very sensitive to the government's financial position. So governments need to be careful when talking about the financial position of the government, particularly for political purposes. And of course, they're very sensitive to the need for governments to be running a reasonably sensible financial position, because in the end, the consumer will pay for everything. So that is really an important element of what we're doing here. The other part of why consumers are worried is job security. The unemployment rate is grinding up. It's not a disaster. It's not great. A lot of it's related to job losses in mining and manufacturing. And I believe that job security issue is also undermining consumer confidence. People who have debt and have obligations don't like to think that their job's on the line. And we need to be creating jobs to reinvigorate the consumer. This is the ANZ job ads, which measures hiring intentions versus the unemployment rate. It highlights really clearly what's going on in the labour market in Australia now, and this will be a key judge over the next 12 to 18 months of how the economy is going. And that is, we're creating jobs in certain industries, we're just not creating enough to offset job losses that are going on in other industries, and of course the new flow of workers into the workforce. And that does raise the other major policy issue I think that's important right now, is youth unemployment. We've got quite severe levels of youth unemployment. Are we creating the apprenticeships and the graduate roles that we need to for the labour force of the future? So this is an important element of the economy. You can see from this is the industry breakdown of employment. Sorry for all the data. I'm not sure why the positive ones are in red. I'll have a chat to my team about that, but maybe it's because we've got a Labor government here in Queensland. But we're creating jobs in the areas that make sense. The non-mining recovery is coming through in construction, in real estate services, in professional and technical trades. There's some stuff related to tourism, I imagine, but we're losing jobs. And that's what's unusual. Typically, if industries are doing well, other industries aren't doing badly. So we're facing this unusual structural change. Mining is obviously going to be shedding the most jobs. Manufacturing has got more to come, and this isn't going to stop. There's going to be another 20 to 30,000 job losses in mining over the course of this year, and I'd imagine there's going to be still at least another 10,000 in manufacturing as those changes run through. Decisions that were made 2 or 3 years ago will be acted upon this year. We will see the economy strong and healthy again when the job losses start to fade and the areas of the economy creating jobs go from strength to strength. And that is the end game for this economy over the next few years. How do we see the weak industries start to contain that, and of course support the strength and the growing industries that are coming through? So in the moment, right now, one of the key things and why we got a cut from the Reserve Bank is making sure the parts of the economy that are doing well continue to. Because in my view, and this is where Queensland comes into it, the future, the next 2 to 3 years of the economic cycle, if we're going to get the recovery, it's the weak states that have got to recover. And that is Queensland and WA have got to drive the recovery. At the moment, it's just New South Wales and to a lesser extent Victoria. At the moment, we need to keep New South Wales and Victoria ticking over because that's the only game in town. But on a medium-term basis, the recovery in Queensland and Western Australia is critical. And you can see here retail sales between the mining and non-mining states, and you don't want to see this trend that's emerged in the last month or two continue. You don't want your only source of weakness going, that is Sydney and Melbourne, essentially. So why did the Reserve Bank cut rates? Well, in my view, part of it is that people are saying they don't want to cut rates and create a problem in housing, and they don't. But at the same time, you need Sydney housing to be ticking over. It's going to keep demand in the economy. It's going to keep things ticking over. People must remember, and I'm from Sydney, we've had a terrible 10 years, so look, give us some time in the sun, give us some good economic conditions. It is the two-speed economy in reverse. And Sydney, and it is Sydney, it's more outside of Sydney and New South Wales, it's not much different to the rest of Australia. It's difficult, but that's the short term. The longer term is, and why the RBA focuses so much on the currency, is getting the adjustments, growing new industries, growing industries that are there and expanding their investment, and the currency is critical to that. The currency obviously going up with the mining boom did a lot of damage, and it coming down now is going to support new investment and new opportunities. And you can see the Aussie dollar versus a model that us economists put together, which we're good at that, but there's lots of errors in the models. But you can see that the Aussie dollar has persistently been expensive because it's been a great place for people to put money, and it's now coming back to about where it should be. The Aussie dollar under 90 cents to the US is helping this economy. The thing is, it doesn't happen overnight. So right now we're already starting to see a response. So here is the Queensland data. Well, the bottom bottom right for you is the response already of tourism education to the weaker currency. It's happening. And we may have a few more lectures being put on, and we may have more wait staff and people cleaning hotel rooms. But the real decisions are whether you're going to build a new hotel in the Gold Coast or whether you're going to build a new wing in the university because you're getting the extra demand. That's going to create the investment, that's going to create the jobs, and that doesn't happen overnight. So the currency's falling, it's now fallen for a little while, and it will work its way through. There is no doubt, I mean, this is using the Queensland data, it's a national story, but it's quite acute in Queensland. It's critical to the Queensland economy to revive some of these sectors. It's actually a lever that can't be pulled in WA. They're much more concentrated than Queensland is around natural resources, but it will come through. The economic environment is settling. We're getting more tourists coming through, more people coming for education purposes, but it'll broaden beyond that to manufacturing, agriculture, and so on and so forth. But it does take time. So here's the story of Queensland, which is the story of Australia. Back to the employment by industry. At the moment, there's good stuff going on in Queensland, but there's equally bad stuff happening. There's jobs being lost in industries at a similar pace to jobs being gained. The net effect is jobs aren't being created. And if Queensland can turn it around, if Queensland can start to contain the losses, which it will gradually over the course of the next year naturally, but then if we can put the policies in place, and if the financial and economic environment starts to emerge, which we believe it will, then we'll get the jobs created in other areas. So there is a cyclical recovery coming on, and of course, that of course will be very much led by places like Queensland. So there is room for optimism, and there are great opportunities out there for this country in the next year or two. Thank you very much.